If you want to gift money to family members, it's important that you understand the potential tax implications of making those gifts. Gaining a basic understanding and staying within the rules may enable you to avoid paying tax on the gift altogether. In this video, we'll be covering what actually counts as a gift, how much can you gift, which taxes need to be considered when gifting, and some special rules. Before we get started, be sure to hit that subscribe button as well as the notification bell to make sure you're kept up to date with all of our latest content. This really helps us to produce more helpful videos and to get you free quality advice from real qualified accountants. So what actually counts as a gift to family members in the eyes of the taxman? Well, HMRC define a gift as follows. Anything that has value such as money, property or possessions, or a loss in value when something's transferred. For example, if you sell your house to your child for less than it's worth, the difference in value counts as a gift. In reality, it would be very difficult for HMRC to keep track of possessions that have been accumulated over a lifetime and then given away as a gift later in life. Cash or bank transfer gifts, on the other hand, are usually slightly easier to identify. Unless you sleep with all your money under a mattress, then there will usually be some sort of paper or digital trail indicating when, how and where a gift was given. And the majority of gifts are usually given to close family and friends who are also included in the will of the donor. That is the person given the gift. So it's expected that any gifts received are disclosed to the executor of the estate of the donor upon their death. Before we continue with today's video, we're thrilled to be launching the Accounting and Tax Academy membership site this year. We'll be posting downloadable resources, tax tutorials, and exclusive courses that you won't find anywhere else. And the best part of it is, it's absolutely free to join. Head to the link in the description box below to find out more. If you want to give money to family members, just remember each individual or donor has an annual exemption for gifts of £3,000 per tax year. This means that a grandparent with 3 grandchildren could gift them each £1,000 without having to worry about tax. Be aware that the allowance is £3,000 in total, not per gift or per person. The annual exemption can be carried forward one tax year, so any unused amount from the previous year can also be utilised. So this can result in a maximum exemption of £6,000 in a tax year for an individual. On top of the annual exemption, an individual can also give away the following gifts each tax year. Wedding or civil ceremony gifts of up to £1,000 per person or £2,500 for a grandchild or great-grandchild and £5,000 for a child. Normal gifts out of your post-tax income, for example Christmas or birthday presents, but you must be able to maintain your standard of living after making such gifts, something we'll look closer at in the special rules section of this video. Payments to help with another person's living costs, such as an elderly relative or child under 18, gifts to charities or political parties. And finally, providing the person you are giving the gift to has not been the recipient of one of the exemptions above, then you can also give as many small gifts up to the value of £250 per item as you like. If you exceed these limits and gift money to family in excess of your allowance, then don't worry, nobody is going to be immediately knocking at your door asking for the unpaid tax. But it is important to know that there may be tax liability at some point in the future for either yourself, your estate, or the recipient of the gift. You may be asking why? Why do HMRC want to tax genuine gifts to family members? Well, without some form of control and gifting limits, a wealthy individual could simply gift away all of their wealth and assets before the end of their life and avoid paying any tax at all. And that tax is inheritance tax, which is in effect a tax on an individual's wealth. In line with current thresholds, inheritance tax is a tax payable on the death of an individual whose estate has a value greater than £325,000. Anything above that amount will be taxed at a rate of 40%. So how does this fit in when you gift money to family members? When you give away a gift in excess of the gift allowance detailed above, which is £3,000 per tax year, the gift is usually considered as a potentially exempt transfer, or PET for short. This is because the gift may still be exempt from inheritance tax depending on when the donor, the person who gifted the assets, dies. If the donor of the gift lives a further 7 years following the date of the gift, then the gift becomes exempt and no inheritance tax is payable. But if the donor dies within that 7-year period, then something called taper relief is applied. It is also worth noting that under current inheritance tax rules, the threshold of £325,000 is increased to £500,000 if the deceased donor is leaving a property they own to their children, including adopted, foster or stepchildren or grandchildren, and the total value of the donor's estate is less than £2 million. Now, there are two special rules that you should be aware of. Number one is that any gifts or transfers between spouses and civil partners are exempt from inheritance tax irrelevant of the amount, on the condition that the spouse or civil partner lives in the UK permanently. Good news for all married couples and civil partners. Number two is that there is also a differentiation to be made between gifts that are made from an individual's savings or existing wealth and gifts made from surplus taxed income. Gifts made from savings or existing wealth is what HMRC target, as it is these type of gifts that would typically fall under the inheritance tax rules. However, if it's gifts made out of surplus income, then these may be exempt. Below are some examples of gifts of regular payments you might make out of your surplus income. Number one is regular deposits into a savings account for your child. Number two is regular support payments to an ex-spouse or civil partner. And number three, grandparents paying their grandchildren's schooling fees. You may need to demonstrate to HMRC that you are able to maintain your current standard of living following the gift from surplus income. If HMRC believe that these regular payments were an attempt to wind down savings income to avoid inheritance tax, then they would be treated as gifts from wealth and be subject to the usual allowances and inheritance tax rules.